So in this short episode, we're going to discuss the safer place to put your money, whether it's a bank or a money market account. And here's a disclaimer, this is our opinion. If you're interested in learning more about this, please continue listening. Okay, welcome to the Red to Black podcast with your hosts, Werner and Mario. Mario, today we're discussing, in our opinion, what's the best place to store your cash in this current environment? Is it a bank or is it a money market account?
Yeah, Warren, thanks for the question. So the banks have systemic risk or counterparty risk. We saw this back in 2019 when the repo market or the repurchasing agreements, the overnight rate spiked to 10%. What that's telling us is the banks didn't trust each other, or they said the appropriate interest rate to lend, for instance, $1 million overnight and get collateral for that $1 million, the appropriate interest rate was 10%, which is astronomical. You know, if you expand that over a 6-month period or a year, it's an astronomical figure. And the reason why was because they believed that the banks were not going to pay them back. Each bank didn't believe the other bank had the ability, if a crisis hit, to weather the storm and pay them back the $1 million, et cetera, that they lent. So the repurchase agreement was spiking to 10%. Now the Fed came in and provided liquidity once the rate got to 10%, because that rate, that overnight rate, has an impact on short-term and long-term interest rates. Money markets, on the other hand, they lend primarily to the federal government. Right now, if you look at Vanguard's total money market or a money market account inside of Vanguard, they have almost zero commercial paper. Right now, they're saying the banks have a lot of risk, and we're not going to lend to the banks. We're not going to be paid appropriately for that risk. So they're purposely just lending to the federal government, to the Treasury, for short-term treasuries, so treasuries that are most likely less than a year, or that are less than a year. The difference there is banks are fractional lenders. They don't have as much money in their bank as they have lent out. They've created deposit. They've taken deposits and created cash. They've created wealth. They've created currency units into the economy, and if those loans don't come due, or those don't get paid back, they're not going to be able to make the deposits, or to have all the money to fulfill their deposits. Short story for you: I have a close friend who bought his dad a classic car up in Central California, and he went to a commercial bank, and asked for $40,000 cash to go make a deal to buy this classic vintage car for his dad's 70th birthday. And the bank was like, "Yeah, you're gonna have to give us a few days to get your $40,000." It's interesting. The bank doesn't have 40 grand. They can't scramble and come up with $40,000. It's a signal that it's tight. These banks they're not generous right now. They're tightening up their lending standards, and it's increasingly difficult to get your own money back. Those are kind of the differences between a money market and a commercial bank.
Yeah, so the reason why we're talking about this is because right now, Mario and I believe we're in this phase where you want to preserve your capital, preservation of capital. Investors will get into this mindset where I've got to constantly be investing and making money. And I know individuals in my family who are investors in certain industries who are thinking that way. The prudent investors like Howard Marks, Warren Buffett, they always espouse to evaluate a business and then patiently wait until that business is trading at a price that you determine from your list of businesses that you've been evaluating. That's a simple way to do it. I mean, it's so simple, yet the challenge is it requires patience, and it requires evaluation, which we said was boring in another podcast, as Jim Rogers said. So that's where we are in this cycle. We're in this, and we believe we're in this preservation stage. So the question is, when we're going to take our money and we're going to put it somewhere, we want to know that the money is, number one, safe. And then number two, we can acquire that money, meaning take it back into our own coffer so we can purchase one of these businesses when the time is right. We're really, I think we're looking at those two things. And whether it's a bank or a money market, we want to look at where's going to be the safest and who's going to give us our money back at the end of the day. My opinion and Mario's opinion is that it's a money market, because a bank, it's a fractional reserve system. And I just recently looked at Discover Bank's 10K, and they had about $7 billion in cash and then $70 billion in deposits. $9 billion in cash, $70 billion in deposits. $7 billion of those deposits were money markets, and then the rest were other depositors. So how long does it take for 10 to 15% of that bank to pull their funds out, considered a run on a bank. I don't know what the actual percentages for a run on the bank are, but it's considered all the deposits are almost gone. The bank's going to cut off that activity. Now, when you come to the money market account, all you're doing there is the money market's just going to be selling treasuries to get your money back, to give it to you. And there's actually, from listening to George Gammon today, there's actually not a lot of treasuries floating around. So there will be people in our assumption that will grab those treasuries willingly and you'll get your money back. So we're looking at these two different levels of risks. Where is it going to be safer and where can I get my money back? Your thoughts, Mario?
Some people will say if you put your money in the bank that's FDIC insured, I'd say good luck, Chuck. Get in line. So one, will it be paid? And then two, how quickly will it be paid? The last thing you want when you have an opportunity is to be in line in a federal agency waiting to get an insurance check. We both have done some government work and we know how slow it can be. And it's really like, well, yeah, your paperwork's been submitted. Call us next week. Call us next month. Call us in 6 months. Yeah, we shift your paperwork got lost. Oh, it's over here. It's over there. FDIC only means, yeah, if they have money, they'll pay you. I wouldn't bank on that being a quick transaction between if a bank fails and the FDIC backs up that bank and takes credit for all the loans, like say 250 or 200,000 below. It's going to be a process to get your money back. Like you said, if it's in a Vanguard money market account or a reputable institution's money market, they're going to be selling treasuries to get cash to pay you back when you make a demand. You're right. 15% of the depositors want their money back. That's a nightmare for most commercial banks. So I would recommend, just as my personal opinion, to you, Warner, not to keep your money in a bank.
Yeah, exactly. And Discover Bank is actually one of the better banks because they not only have, I was looking at their 10K, they have two components to the bank. They have a MasterCard component, which is extremely lucrative, where they have merchant accounts and they're making money off of those accounts. And then they have their banking section, which is personal loans, home equity lines of credit, student loans. And they are actually lending out with pretty strict standards. They don't do adjustable rate on any of that stuff. It's all straight up. Here's your interest rate. That's it. So that bank is probably, out of all the banks, is probably taking a lot of the risk out of it. But it's still, as we talk about in other podcasts, it's still the underlying fundamentals don't create this like cash cow business that will be around for 300, 400 years. Maybe it will. Maybe I'm wrong. But the underlying fundamentals of a solid business, there's not a lot of hiccups. It's just like ups and downs, and the business just keeps humming along. So why are we talking about this? Because there's like this fairy tale sort of view of banks. Like I put my money there and the FDIC is going to give it back to me. But if you actually applied accounting to it and said, hey, how much money does the FDIC have? I don't know. I know it's not enough to cover all the banks.
It's way underfunded.
And then asking the question, well, there's a run on the banks. The banks are stopping people taking out their money. So now you're in two quandaries. You can't get your money out. And then the FDIC won't insure you. They don't know where it is. So you're caught in all these different, we want to avoid you getting caught in these obstacles, these slowdowns, because when you're slowing down, you're hitting obstacles, you're not grabbing that money and purchasing high quality assets. So that's the whole goal of why we're talking about preservation of capital and where to keep your capital. And I think that's it. Mario, you have any final thoughts?
Nothing to add, Warner. Thanks for the time.
Okay. Thank you so much. All right. Bye. Thank you for listening to this podcast. We invite you to get to know us by clicking on our LinkedIn profiles in the description of this video. Please subscribe, hit the bell notification for future updates, and share this content with your networks. Thank you for your valuable time and insights. We greatly appreciate it.